Welcome to Sprott Media. I'm Albert Liu. Well, in football, defense wins championships, but will defensive investing save your investment portfolio? Joining me ahead of the Las Vegas MoneyShow is Mike Larson, Senior Analyst at Weiss Ratings and editor of the Safe Money Report. Mike will be a featured speaker at the Sprott 2019 Natural Resource Symposium in Vancouver. Please look below the video for details. Mike, great to see you again. How are you?
I'm doing very well, thank you.
Well, you're off to Las Vegas for the Money Show, and I think what attendees want to know from you is basically, are we caught in a massive stock market bubble once again? Or is this, what we've seen lately, just an extraordinary market boom? I know you like to get into the data, so what does the data tell you?
Sure. Well, if you look at the history of this bull market, or the move pretty much since 2009, it was a very steady, well-supported, strong advance from March of 2009 through about January of 2018. But what we've seen in our own proprietary data and kind of my sense of the market and what my research has turned up is that things really started to transition after that point. The same kinds of stocks, for example, that were leading the market before January of 2018, which would be your offensive, high growth, cyclical type names, have started to lag at that point. And it was really the more defensive, yield-oriented, higher-rated type recession-resistant companies that were taking the lead. So, I would shorthand it by saying, it would be industrials and basic materials down or underperforming along with financials, but things like real estate investment trusts, utilities, and other more defensive companies taking the lead. And at the same time, of course, we all know if you look at what the S&P 500 has done since January of 18, we've seen some pretty big swings both down and up, but essentially haven't made any progress. If you measure something like the Wilshire 5000, the broadest index of the U.S. stock market, I did that a few days ago, and you look at the difference in the performance of owning the Wilshire 5000 from January of 2018 through early May of 2019, it returned about 1.5%. You could have made about 4.5% just owning long-term U.S. Treasuries. So again, it's a market that after several years of sort of a very well-supported, strong bull market, we've seen a real transition to now where the defensive type stuff is winning, and you've really got to play that or adapt to that kind of a market environment versus follow the same strategies you would have for the 8 or 9 years prior.
Mike, and you bring out a good point. If you just look at year-to-date performance, you're going to get a pretty misleading indicator on a lot of these indexes just because we had that pretty serious pullback in the fourth quarter, or actually after September, October of last year. If you pull it out to 1 or 2 years, you get a much more realistic story. You make a point of pointing to the semiconductors because they've been on a tear lately, and that was one of the sectors that, in 1999, 2000 just ripped before the big collapse. Now, I haven't followed this industry for a little while, but what applications are driving it today?
Sure. Well, if you talk about the performance of a few select sort of anointed stocks, I call them, and that's what I brought up, the comparison of what's going on in semiconductors in particular, but the tech sector in general. Truly some incredible numbers. The first 4 months of this year, for example, before the market started to have trouble in May, you had the NASDAQ composite that was up about 23%, and the semiconductor sector that was up about 33%. Now, again, some of that's distorted by what happened in late 2018. But again, if you annualize those numbers and basically say, okay, if what happened in the first 4 months of 2019 continued, you find some astonishing relative performance. And you can take it as encouraging, or you can take it as a real sort of warning sign about bubbles-like behavior that's out there. Yeah, the semiconductor sector was on track to run up 154% this year based on those first 4 months. And the NASDAQ was on track to do annualized gains of about 87%. At the peak of the dot-com bubble in 1999, the NASDAQ composite was up 86%, and the semis were up 101%. So basically, I know it's a lot of numbers to throw at the listeners here. What that means is that tech in general, and semiconductors in particular, were on track to outperform the return that they generated in the single biggest year of the single biggest tech stock bubble in U.S. history. So I think that shows that, behind this broad market that's swung a lot to and fro, you see particular sectors that are exhibiting bubble-like behavior. And within even the tech sector, I mean, you can see it particularly in the initial public offering market, right? You've had all these companies coming public in the last 12 to 18 months that don't have any profit, Last year, the numbers are simply astonishing. You had 85% of last year's IPOs that didn't make a single penny of profit in the year preceding their offerings. The only time we even came close to that was at the peak of the dot-com bubble. So again, that comes up. That comparison comes up again. So I think, if you're looking at what that says about the characteristics of the market overall, again, it shows there's a lot of sort of inherent volatility and dangerousness in just speculating in some of these tech names. And I think that it shows you why you have to be defensive. If you're looking for sort of prudent, sustainable profits, you're going to find it in those other sectors that I think offer, again, all those benefits that you're not going to get in things like tech. You're going to get yield protection. You're going to get higher Weiss ratings. You're going to get recession resistance, because some of these indicators, things like the Treasury yield curve, for example, are pointing to a potential recession in the next 12 to 18 months. So again, I think that some of the data and some of the changes that I saw beginning in early 2018 signaled that it was time for me to tell our listeners and our investors and so on to get more defensive, to raise cash, rotate out of the offensive stuff into defensive sectors. And really, that's paid off. I think that kind of strategy, that safe money strategy, if you will, has worked since January of 2018. And I'm pretty convinced, based on what I'm seeing, it's going to continue to work as the rest of 2019 plays out and we roll over into next year.
It's an interesting comparison you make, Mike, because back in the 99, 2000 tech boom, these companies had profits, but the profits were deceiving because it was based a lot on telecom, build out that was often vendor financed, and so someone was actually taking a loss for those profits. Here you're actually pointing to companies that are reporting losses, and they're doing it year after year, and they're mature companies at this point, IPOing for just some amazing valuations. Can you just list off briefly some of the ones that have caught your eye?
Sure. I mean, and you brought up a good point there, because in the dot-com bubble 20 years ago, these were very young companies that were losing a lot of money. And you could make an argument, though. I mean, in the traditional startup culture, it is normal to lose money for a period of time. You're building out your business, it's a new business model, and so on. But what's shocking is that the companies today that get all the press, these tech unicorns, if you will, have been losing money for years and years and have no logical path to profitability. I mean, Uber is a great company in terms of the business, what it does. I mean, 10 years ago, nobody knew that you were going to have ride sharing, and now we all use Uber, we all use Lyft. But it's the valuations and it's the money lost that is astonishing. I mean, this is a company whose valuation rose more than 2,200% or 200,000% without generating a penny of operating profit in a full decade of operation. You have a company like DoorDash. I mean, the quote-unquote revolutionary thing they do is deliver food. I mean, it's nothing spectacular or special. They're a food delivery company. 5 years ago, DoorDash was valued at $72 million. In a recent funding round, it was valued at $7.1 billion. And again, that's despite never earning anything. And you have other companies, examples, the list kind of goes on and on. This Beyond Meat company, they're a meat alternatives product maker. Their sort of niche and specialty is that they've found a way to make plant-based food taste more like meat. But again, the company was founded in 2009. It lost $28 million on an operating basis in 2018. It lost $28.6 million in 2017. It lost $24.8 million in 2016. I mean, the company has never made any profit in more than 7 years of operation, or almost 10 years of operation, and yet its stock went up more than 200% in the first few days after its IPO. So that's the kind of risk-taking that's been going on. That's the kind of stressed valuations we're seeing. And it's really the kind of manic, very end-cycle behavior, in my opinion, that you saw at the end of 1999 heading into 2000. I mean, I used to work at a dot-com. I was kind of caught up in the middle of it. I saw it firsthand. And many of the same things that people were doing back then, and the same careless investing that investors were doing back then, that's reappearing in a somewhat similar fashion now. I mean, Mark Twain supposedly said history doesn't repeat itself, but it often rhymes. And there's a lot of rhyming going on in the tech sector these days.
I remember Ben Graham, I think in The Intelligent Investor, wrote that toward the end of a cycle, you see the deals, the IPOs, the quality of them starts to get poorer and poorer. And I think what you pointed to are many of those ideas. And I think that sometimes investors forget to make a distinction between maybe a great idea, an interesting service, maybe even a revolutionary service, and a good investment. Yeah. And I think you've pointed to a lot of good ideas and great services. Uber, DoorDash, I personally love. WeWork comes to mind. There's a lot of businesses that are providing great services to their clients, but that doesn't necessarily mean they're great investments. And oftentimes, it's sort of the boring ideas and the more steady, mature businesses that end up being better investments. And I know that's where you look. So can you give us an idea of particularly what you're looking at these days?
Yeah, absolutely. I mean, it's funny that you used that word because in a recent presentation, I actually said, I alluded to the movie Wall Street, and I said, I point out Gordon Gekko and his whole greed is good theory. Frankly, in this environment, in this sort of emerging economic credit cycle position that we're in, boring is good. You want to own companies whose operations are less glamorous, maybe boring if you want to use that word, but making money isn't boring. Making money is fun. And it's what we're all trying to do as investors. And I think that it's the companies that have these steady Eddie type businesses, these safe money business models. Those are the ones that, again, have started to outperform since the beginning of 2018. And in my opinion, are going to continue to do that. So I'm looking at select real estate investment trusts that are in more sort of defensive parts of the real estate business. I'm looking at consumer staples type names, the stuff that we all have in our pantry or on our refrigerator shelves. I'm looking at things like utilities, which have yield protection. They're sort of bond-like investments. So in a situation like now where people are concerned about global growth and that's sort of suppressing long-term interest rates, those are a nice play. I mean, the idea, again, is to focus on safety, safe yield, safe money. And again, that more defensive type positioning, I think, makes a lot of sense. And I also like gold and gold derivatives, not gold miners, for example. I think that you're in an environment where overall market volatility is going to go up. It's already going up. One of the things that's sort of noteworthy about the rallies in the S&P, for example, each successive minor higher high in the S&P was not confirmed by lower lows in the VIX, the key measure of volatility. What does that tell you? That's sort of, again, that non-confirmation stuff going on tells you we're changing. The market environment is changing. So in an environment of higher volatility, higher risk, the risk of things like what happened, for example, at the tail end of 2018, those big market downturns, that type of environment, I think gold as a sort of a safe, solid volatility insurance type investment makes a lot of sense here. And then obviously higher gold prices would be bullish for the companies that mine that metal. So that's one of the reasons I've been more bullish on that part of the market for several months now.
Yeah, Mike, of course, I'm an advocate of gold, especially as a protection device for not just the crash, but basically the fix, because the fix often includes a lot of inflation. So I definitely like gold for that. But I think one of the things that many of us, hopefully we're all better investors than we were before the crash. One of the things I've learned is that the Fed and central banks are really getting good at covering their mistakes. Their Band-Aids are getting better and they last a long time. And so what I like about what you're saying, even though I already liked utilities and REITs and those kind of income generating, safe, more equity / fixed income investments, is that we could be in this holding pattern for a lot longer than many of us think. And so it's really nice to be, clipping the coupons, getting the dividends in the meantime while we wait for the adjustments. I know you got to get going, Mike. So just any parting thoughts for the viewers before you head out to Las Vegas?
Sure. Well, again, all I can say is that it really does pay to be more defensive, focus more on safety, be more conservative after a period where doing almost the exact opposite for a number of years was your best move as an investor. I always say that, or when I look at this market, when I look at what's happened sort of post January of 18 and pre-January of 18, is the market environment started to change. It's still changing. And as an investor, we have to adapt to that new market environment. The same strategies that would have worked pre-2018, in my opinion, are not going to work as well, or in some cases could actually cost you a lot of losses in 2019 and beyond. So again, when the market changes, you've got to change with it. So all of the things I'll be talking about in the next several months are going to be focused on how investors can adapt to that environment and again, make the best of their portfolios as a result of those changes.
Sounds like what you're saying is that the rules favor offense both in football and in investing, but defense ultimately wins championships. Do I have that right?
Exactly. That's the famous quote, defense wins championships, and it applies now more than ever.
All right. Thanks, as always, for joining me, Mike, and I look forward to seeing you in Vancouver. Please, if you're watching the video, look below for details. Thanks very much, Mike. Look forward to speaking with you again soon.
Thank you.